What's been happening in the market? And more importantly, what does that mean for you? Welcome to LVZ Market Minutes, the quick and refined update designed for savvy investors who value clarity over clamor. Our team breaks down the trends, movers, and the headlines that matter so you can stay informed and cut through the noise. Let's dive in. Past performance does not determine future results. Securities offered through Harbor Investments, Inc., member FINRA SIPC. Investment advisory services offered through LVZ Inc. LVZ Inc. is a federally registered investment advisor. All right, Joey, we're sitting down. It's the end of March. Today is March 28th, about to wrap up not only the month, but also the first quarter of 2025. We've talked relentlessly about tariffs and the impact of them. We've ridden the market performance roller coaster through the first quarter of the year. There's a lot to dissect and discuss for clients today. So give me a recap of not only the month of March, but the quarter. What were some key things we saw transpire and what did that mean for clients and their portfolios?
So markets in March and in this first quarter, if we're just talking about equity market stocks, have not done great. March was down in all three of the major indices, S&P, Dow Jones, NASDAQ, and year to date, it is also down. If you'll remember, we talked in January and it ended up positive in January, which just kind of goes to show what February and March have been, to pull the positive of January down to where we're now in negative territory year to date and over the month of March. A lot of that is due to uncertainty. So much of market efficiency is using information that's public and then the investment community pricing things based off what they perceive will happen with that data. When you run into large amounts of uncertainty, it's really hard to price things in. We talked about the valuations. Stuff kind of starts to implode because nobody's sure how to correctly value something because nobody's really sure what's going on as far as forward-looking data. So a lot of what we're seeing is due to uncertainty, and that comes into play on the political side, which we'll get to. As far as there's a lot of unknowns in what's happening in that space. A lot of it comes into interest rates, how that affects companies, their CapEx spending, the capital expenditures. There's so many unknowns and nobody's really quite sure yet what's going to happen next. One of the beauties of the market and why we encourage people always stay in the market, stay the course, stay invested, is that when the market finds stability and gets a sniff of good news, then it starts pricing that in, and that's when it starts to accelerate. So we don't know when that stability comes. We don't know when that snippet of good news comes. But once the market is able to confidently price that in, that's when it starts to accelerate again forward.
Speaking of the market being down, we've ridden that ride down for a little bit. As of today, the S&P 500 for the month is down 2.8%. Year to date is down 3.25%. Is this normal market activity to go down this much? Does this volatility season feel out of the norm? Talk to me a little bit about what that normal correction looks like.
We talk about how there's nothing new, but also nothing's ever the same. So we've never seen this exact market before. Have we seen a 10% drawdown? So a drawdown is when an index is trading how much below its previous high it is. So for example, the most recent high in the S&P 500 was February 19th. It closed 6,144. Yesterday, it closed at 5,693, which represents a 7.3% drawdown. We hit a 10% drawdown, which is one of these benchmarks somewhat arbitrarily because it's a good round number of 10. Nobody's looking for that 9.32% drawdown. A 10's a good round number, so that's kind of what we use. We hit that in mid-March. One thing I would say is that since 1950, the S&P 500 has had 34 10% drawdowns, which comes out to about every 2.2 years. So if you're investing over 10 years, you mentally should plan that roughly 5 times over the next 10 years, you're going to experience a 10% drawdown. It's broad information. In like the 1950s to 1990s, it's a little more frequent than it has been since 1990 to now. But overall, that holds true that roughly every couple of years, you're going to see it go down, and that's part of the plan. That's where it's so important to be working with an advisor. An advisor should be communicating up front when they're talking about being in equities and that's how you can get to your long-term goals, the reason you can get there is because of risk.
Mm-hmm.
Everything has a risk premium reward. So you're not going to get better rewards if you're not taking on a risk. Part of that risk is that roughly every 2 or so years, the market is going to take a dip in value. But it's really important to remember it's only a loss if you sell it. Mm-hmm. So as long as you stay with your funds, stay with your investment policy, and you won't have those losses as long as you don't sell. Kind of a good way to think about it is that, so we talk about there's been 34 10% drawdowns since 1950. The market is currently trading, so if you look at the S&P 500, it is currently trading higher than all but one of them, and that's the one that we're currently in. Every other 10% drawdown, we've recovered and moved further past. So to remember that this is part of the plan as an investment strategy, this is factored into what it means to be invested.
Sure. And of course, past performance is no indication of future results. So understanding your own risk tolerance and how to position your portfolio is important to review it with your advisor. And if for some reason it has changed since you started investing, it is important to return to your advisor and reevaluate that risk tolerance that you may have as a client.
So many times you'll see advisors, they give out this little survey to their client and say, how risk averse are you? And I don't know if you really know how risk averse you are until you are in the risk. So these are actually great opportunities to connect with your advisor and say, this downturn, this risk, this hurts more than I thought it would. Or I'm really not bothered by this. Should we be stepping it up? Should we be exposing ourselves to more long-term potential return because I'm not too worried about the short-term risk? If you can have those conversations with your advisor, get everybody on the same page, that's a really good opportunity.
Right. Moving into beyond what happened in the markets, let's talk about what's on the outlook. So the Atlanta Fed gave a projection. Of course, this is not an actual GDP number, but projected GDP going down based on some negative pieces of information or data points that they're collecting. What does that mean as far as that projection, what the overall import-export market, consumer spending is doing from the past month and then looking forward?
The numbers came in as a projection of what will be released, and that'll come out sometime next month as a summary of the first quarter of the year. There's really two main factors that contributed to a projected decline in the GDP. The first is with the threat of tariffs coming in, a lot of companies are essentially front-running their imports. They are trying to import now everything they think they'll need in the short, near-term future because it's essentially cheaper now than it will be potentially in a month. So what you saw was a big spike in the imports, and the exports remained relatively the same. Net exports, which is exports minus imports, you add it in the GDP calculation, but if your imports are larger than your exports, it becomes a drawdown on your GDP calculation. A higher amount of imports, the same amount of exports, what you end up is a decrease in just the very basic calculation of GDP. Pair that with a decrease in consumption, which is also an add to the GDP. When that goes down, that's going to pull down on the GDP. Those are the two main numbers that were pulling that. It's been a while since we've seen a drop in consumption, and the February numbers just came out. It did resume going up in consumption, which that's a good thing to see, to not see that drop 2 months in a row. But with that, there are signs that people are concerned beyond just the stock market. There's consumption slowing down because there's a threat of tariffs, and nobody's sure what is going to happen with prices. Nobody's sure what's going to happen with tariffs, really. There's a lot of unknowns around that. And again, similarly to the stock market, uncertainty makes people pause.
Right.
And so some people are pausing with spending and wanting to be more cautious, which is resulting in those numbers coming down.
Yeah, most of what's taking place right now is simply speculation on how they think that tariffs will play out, some of the residual impacts of that, and making proactive choices based on their gathered data, just gut instinct, or maybe risk tolerance for their own company or themselves personally. We talk a lot about creating clarity out of headlines, and when there are so many headlines giving you false information or just creating hype around an issue, it's really difficult to find actual information. And so there's generated a lot of behavioral response, which in turn creates the uncertainty that drives market movement in different directions. Tariffs continue to be the topic on everybody's lips, from the dinner table to business circles to digital news. If you Google tariffs, you are going to get a slew of information that you have to sort and navigate through. So tell me, Joey, what's actually gone into play? We had one that was pending for March 12th. What's actually been implemented? What has been some of the results? Give us some clarity on cutting through the headlines related to tariffs for what are the facts.
There's been a lot of tariffs proposed, but they've also been pushed off until April 2nd. That's when we're going to know a lot more. Next month, we'll have a lot more to review in that sense. But there was the one tariff on steel and aluminum where they increased from 10% to 25%. That's really been about it. And so for all of the conversation, for all of the talking, there has not been much yet. We're going to see very soon, probably next week, what's actually going to happen. Or is it going to get pushed down the road again? Is it going to be another month until these are implemented? And then at what point does it become a crying wolf? The fact that at some point it needs to be resolved and it needs to be clear what's happening. We're just not there yet. It's still not quite clear. And I will say it's important to acknowledge that from just a basic understanding of tariffs, imposing tariffs has a negative shock to the short-run aggregate supply, which is used to calculate GDP, production of the economy overall. When that negative shock happens, it can decrease the production from a company and has the potential to increase prices. So there is a very real, practical effect that something like a tariff can have on a consumer. With all the talk of, it's noise, the tariffs, we don't know, there is a lot of unknowns on how that can affect and will affect and to what degree it will affect the consumer. What we don't know is to what level that will be because we just haven't seen them implemented yet. I think it's good to affirm the frustration and the kind of anxiety around these tariffs because it has the potential to very directly impact consumers. We just don't know quite yet to what degree.
Right. And as you've mentioned before, tariffs are really a negotiation tool. That negotiation is still being played out until the desired terms and outcomes are met from a political standpoint. That's something that we'll continue to see play out. Obviously, it could get pushed out further than April 2 if that negotiation continues, right? We'll have to check back next month to see where we're at in the negotiation process.
See if there's actually any progress.
Joey, so thinking of tariffs related to global markets, globally, is there anything taking place that's impacting domestic markets, and what does that outlook look like for the next quarter, next month?
There's a lot of companies that seem to be bracing for when more is known. There's potential impacts on company spending. There's so many second effect variables. If prices go up, if inflation goes up, what do interest rates do? Depending on what interest rates do, that affects small businesses. Depending on what small businesses do, that affects consumers. There's so many knock-on effects that I think a lot of what you see in the market, consumers, what you see in the market from investors, is just trying to wait and see how to respond to something that we just don't know yet. And that's playing into the volatility, it's playing into the unknowns. What I will say is probably important to touch on this month is we've seen a lot of growth and outperformance in international markets this year. That comes into play. One, there's a lot of uncertainty in America. There's a lot of uncertainty in the global relationships between America and these other countries that we're going to have to wait and see. One example of other countries sort of taking initiative to change things on their own front is Germany had a big increase in their defense spending, which put a lot of money into local German companies, which has then seen those companies perform really well, which has seen the international and the German markets perform really well. There's a lot going on in other spaces in response to what's going on in America. That's why we diversify our portfolios. So in our investments, we have exposure to international markets for moments such as these. When there's uncertainty in America and the European markets are doing well, we have exposure there to help offset any of the unknowns in the short term.
That's a great point. And speaking of investment philosophy and in our approach to market volatility. What have we done to be proactive in our portfolios? Is there anything specific that we've positioned differently? Talk to me a little bit about what our investment committee has been setting up, proactively responding to potential shifts.
The big change that we made, we talked about it in one of the previous episodes, was trimming a bit of our small cap exposure and going into a value space, larger cap, stable companies. We did this with the understanding that valuations are really high. There's a lot of potential volatility that could come into play that wouldn't be surprising. I think that's a way to think about it. When you look at a market and we don't know what's going to happen, but if you say, could be a really volatile year for small caps, and I wouldn't be surprised by that. That's something to take into consideration. If trends that would indicate this could happen, whether it's the scenario with interest rates, whether it's CapEx spending, whether it's international volatility, whatever it is, positioning ourselves to be prepared for whatever happens. And that was the move we made. Trimmed a little bit of small cap, went to value, and tried to find stability.
It's a fun time to be watching economic indicators, to be assessing the data. But that's the beauty of economics. It's almost like a mosaic. There are many facets that play into the final result, different pieces and shapes that make up a very complex work of art, if you will. Next month, we have a couple of things coming out that are also going to generate impact. Of course, the GDP information officially coming out. We'll be digesting that at the end of April for everyone. Do you have any insights or wisdom as we still are riding the volatile markets moving downward? It could change direction the next day or next week too. So, Joey, give us some insight for wrapping up the quarter, wrapping up March, and moving into April.
If I could leave with one comment on everything that's going on, it's reminding us that what we're seeing right now is not the signs of a non-functional market.
Mm-hmm.
It is the sign of a market with risk, which is part of what we plan for when investing long-term. To not have risk, we would not get the rewards that we get out of the stock market.
Exactly.
It doesn't build wealth over time the way that it does without risk. Understanding that in the context, again, that it's only a loss if you sell. So talk with your advisor. If you've got some big bill coming up next month that you need to figure out how to create cash for, talk with your advisor about that. But overall, this is part of the plan. It can go down from here. It could go up from here. It could stay the same. But being in the market means being exposed to risk.
Mm-hmm.
And it's important to remember that when we're invested.
We talked about a couple of things today, like market drawdowns, the GDP. So if there's any information that you want to learn more about, make sure to check the show notes. We'll put the links for our cited sources in there, as well as the data and the facts to back up tariffs. If you're interested in learning more, make sure to check the show notes from today in our show description. Thanks, Joey, for your time today. And I look forward to seeing what transpires in April, and if we get to talk further about tariffs and their actual legitimate impact, or if we are continuing negotiations. It could be a fun back and forth to watch transpire.
No way to know what's going to happen next. It's just random.
That's the beauty of economics, right?
There's literally no way to tell what's going to happen. But then it's just fascinating to look at all the data once it comes out. I guess we'll see.
That concludes this month's LVZ Market Minutes. Quick, clear, and curated to keep you informed and empowered. If you found these insights valuable, be certain to tune in each month for a strategic update. Until then, stay informed, stay invested, and have peace of mind that our team is actively monitoring the markets and managing your portfolios.